Hi everyone, my name's Dan Murphy. I'm from CNBC International. Really thrilled to be here today and thank you for the invitation. Dr. Mobius, thank you for being here as well.
Glad to be here.
I thought we could begin.
The gold chair. I'm a fan of gold.
And not just a prolific investor and an influential voice on the markets, but probably one of the best dressed investors I've seen in a long time. So thank you, Dr. Mobius. I think we can begin our conversation just by getting your reaction to some of what you've heard from Nouriel there. It seems as if Nouriel feels like the world is about to come to an end. What's your view?
Well, I mean, I like to tell young people that we're now living in the most glorious period of mankind's history. I mean, if I go back to the time when I was studying and what the costs of a telephone call from Boston to New York was, at that time, $10, $20 for a 1 or 2 minute call. Today, I can do it for free. So, I mean, this is just an indication of the incredible advances that have been made globally. So, I always tell young people, you're living in the most glorious period of mankind's history. It's a wonderful time to be alive.
And last time you and I were together, it was for an Asian Development Bank conference back in September of 2020. And obviously, the world has changed really significantly since then. So I thought we could get a view from you on how you're seeing the regional economic recovery, but also the global economic recovery. Where do we stand?
Well, just look at what's happening here in the UAE. The incredible advances have been made. 20 years ago, I was here and it was all desert. And now you see this incredible economy being built. So the advances that are being made, not only in the Middle East, but in emerging countries generally, have been quite remarkable. And one of the reasons for that is the internet. The digitization of the world has meant that there's more information available to more people than ever before in mankind's history. Now, of course, there's a danger of that because crises spread throughout the world more quickly. But generally speaking, it's been an incredible boon for countries all over the world.
And globally, how do you see the recovery shaping up? Are you encouraged by what you see so far?
Well, you know, my view on this whole currency inflation issue was outlined in my book. I'm going to give a plug to my book, The Inflation Myth. And in that book, I argue that, first of all, the way inflation is measured, the CPI, the Consumer Price Index, is flawed. It's just wrong because you're using a basket that changes from year to year. So the basket of goods and services that they use for the inflation numbers today are quite different from what they were 10 years ago. So you're comparing apples and oranges. So if you then take that premise that CPI is inaccurate, you should look at money supply. Money supply in America is going up by about 30% recently. And if you go back, you just have to look at your Bloomberg terminal and look at M2 going back 20 years. And it goes like this. It's a straight line. It doesn't go down. It continues to go up. What does that mean? That means your currency is being devalued. That is what inflation is, not the CPI. So you can assume that the currency is being devalued by at least 30% a year, at least. The good news is that technology is coming in and making goods and services cheaper. And I pointed out communications, and there's so many other examples of that. So you have these two countervailing forces at work. And that's the reason why I advise people that when you're looking at investments, think of technology. I'm not saying you buy semiconductor companies, but I'm saying you buy companies that are utilizing technology to increase their efficiency and their ability to produce cheaper and cheaper goods and services.
So just on the inflation narrative, there is a view out there that inflation is going to run hotter than the Fed and what the markets expect. Perhaps inflation is coming to ruin the equity party. Do you subscribe to that view or not?
Oh yeah, no question that inflation should be much, much higher than the numbers indicate. And now they're looking at roughly 5%, but as I mentioned, It's not the inflation number you should be looking at, but you should look at the devaluation of the currency. Again, as I point out in my book, no currency in the world has remained and has been able to survive. All currencies devalue, which is why it's so important in order to preserve wealth, you've got to be investing in companies that are adjusting their prices with the devaluation of the currency.
I wanted to ask you about the oil price outlook as well. This is something that Manus and Noriel picked up on, so I'll get your reaction too. This morning we saw Brent moving back above $84 a barrel, so significant moves in the oil and gas markets, and this has been called a crisis in Europe, which policymakers are now being called upon to address. Do you see 90 USD oil or 100 USD oil on the horizon? This would be very, very consequential for our region.
Very easily. There's no question that because of the devaluation of the currency. And by the way, we're not talking about just oil. Look at all the other commodities. They're all up. So no question, oil, gas, palladium, platinum, gold, you name it, all of these commodities will be going up in price because of the devaluation of the currency. Of course, the timing of these changes will be different, but there's no question this will happen going forward.
100 USD oil on the horizon.
Easily, easily. But don't forget, technology is going to make cars more efficient. You're moving into electric cars. There are many other things that are happening that will result in the cost of transportation to the guy on the street going down in terms of his earning power.
Okay, so what does that mean for your overall investment strategy? Because when you look at the scenario out there, oil and energy prices are soaring, as we've just discussed. The dollar has been strengthening. The Fed is about to begin tapering back on asset purchases. And all the while you have inflation fears also lingering in the market. So what does that do for your EM outlook? Where does it leave the investment strategy now?
Well, that means that you've got to look for companies that are going to benefit from these changes. For example, semiconductors. As you know, there's somewhat of a shortage of semiconductors now, but we know, just take transportation. If you look at the demand for semiconductors, the largest number of semiconductors goes into automobiles today. A lot of people don't realize that. What does that mean? That means that semiconductors are being used to make automobiles more efficient and more user-friendly. And that is eventually lowering the cost of transportation for people. I mean, I know whenever I drive with someone here in Dubai, I put on Waze. You know the Waze, I mean, here's an amazing development that makes your driving so much more efficient. So this is an example of the changes that are being made. So what I'm telling people is that look at companies that are going to take advantage of these changes. So, for example, in our fund, we've invested in the so-called fabless semiconductor companies that do the design and software for semiconductors. That's a field that we believe is going to be growing very rapidly.
So in order to be exposed to a sector like semiconductors, it means you need to also be exposed to the China story. And investors have had issue with that this year in particular, because what we've seen is very successful examples of capitalism being taken down by the Chinese Communist Party. The regulatory risk in China is immense now. So what's your view on that? And how do you see this regulation narrative playing out moving forward? Because it's hard to win in China if the government can just come out and say, well, hang on a second, we're going to be taking over this business now.
I think the U.S. has made a big mistake in restricting exports to China, because what it meant is the Chinese now realize they've got to develop their own semiconductor industry, which will compete with the U.S. semiconductor industry. They will also have to develop their own software industry. So I look forward, by the way, I'm not biased against Microsoft, but I look forward to the day when the Chinese develop an operating system that is cheaper than Outlook, than Microsoft. And I think that will happen. So in some ways, the actions that the U.S. has taken is going to come and bite them, because it's going to mean more competition for U.S. companies.
The regulatory risk in China, you've said before that it's not necessarily a threat for positioning, investment positioning. It's actually an opportunity. Can you elaborate on that?
Yeah, I mean, if you look at corporate governance in China and you look at the actions of many of these companies in China, many of these companies have been doing things that they never would have gotten away with in Europe and America. And now the good news, in my view, is that the Chinese government is beginning to crack down and beginning to look at anti-monopolist practices, and generally speaking, improve the governance of these companies going forward. The other aspect of this is that by cracking down on the big guys like Alibaba and Tencent, the smaller guys, the medium-sized companies, will encounter a more level playing field, which will be good for these companies. So I advise people to look at these middle-sized companies because they will be benefiting from these changes.
So why are we seeing big-name investors like Cathie Wood pulling money out of China now and basically liquidating positions on the ground there, saying the regulatory risk is too much for me now?
Well, the problem is that, yes, if you look at Alibaba, Tencent, and these big guys, they are a big part of the index. The China, whether you look at MSCI or any of these indices. And one feature of investing these days is that people tend to be indexing more and more. And the rise of the exchange-traded funds, ETFs, now means that at least half of all investments are indexed. So as soon as the Chinese index goes down, and by the way, the emerging markets index goes down, because China represents 30% of the index, everybody retreats. They say, oh God, emerging markets are in trouble, China's in trouble, I'm getting out. So the result is you see people pulling money out as a result of that. The smart money is going to say, hey, wait a minute, this is an opportunity because China's down 30, 40%. There are going to be opportunities in China because China's not going to go away. They're going to continue to welcome investments.
There are some out there who say China is uninvestable in this environment. I think you would disagree with that, though, because I know from recent reading you're still putting money to work in China. Just elaborate for us a little further on where the opportunities are in a market like China, and then once we get through that, we'll go into India as well, which is where your biggest allocation is. But how else are you putting money to work in China?
Well, as I mentioned, I think the great opportunities are in the medium-sized companies, medium and smaller-sized companies. By the way, when we say smaller, some of these are multi-billion-dollar companies, because in the context of the whole China economy and China market, the medium-sized companies are actually pretty big. But as I mentioned, there'll be advantages for these companies, but don't ignore the big guys because they've come down quite a lot. So there will be opportunities there, but it may take time for them to recover. So I would advise people to go into that middle ground.
India is still the biggest allocation at the moment, though. So why is India still such a high conviction market?
India is going through an incredible transformation. I always think of India as not India, but the United States of India. Because if you look at the individual states in India, you realize they're very different from each other. Now, it's true if in America, you go from New York to Kentucky, you may not understand what the guys in Kentucky are talking about. But in India, you have different languages and different written states coming to cooperate with each other. A good example is the excise tax. That has improved relations between these states. But there are other things happening. And again, it's technical and technology that's making this difference. For example, the ID card that now is being issued to all Indians. This is an incredible boom. It's a way now for people to have bank accounts. So all of this technological change is having a very big impact on India. So I see the growth of India going forward as being very, very good.
What we'd also like to do is see if the audience maybe has some questions for you as well. I think that would be a good way to sort of get a sense of how people in the room are feeling about some of what they've heard today. So if anyone has a question for Dr. Mobius, please come forward and we can get a microphone over to you.
Hi, Mark. It's really a pleasure to see you here. I have seen you on the Indian business channels quite a few times. And my question to you is, what is your view on the Indian market from these levels? The markets have gone up quite a bit since the pandemic broke out. So I would like to know your views about the Indian market and the emerging markets in general.
View on the Indian market. Well, if you look at our portfolio of our fund, you'll see that a little bit over 20% is in India. It's the largest allocation we have. So that gives you an indication of where we stand. But we're not buying the big blue chips in India. We're buying the medium-sized companies. And particularly, we're focused on medical care. And by the way, that's one area where we're focusing not only in India, but in China and in other parts of the world, because we believe that, generally speaking, rising incomes and aging populations, particularly in a place like China, is going to be a big boon for medical care. And we particularly are focusing on medical testing. The other area is education. We think that the demand for education for private schools is going to be increasing, and therefore we have investments in Brazil, Egypt, China, and other parts of the world in the education sector. And then, of course, technology, software. India, as you know, is an incredible developer of software, exporter of software, and we want to do more and more in that area.
Thank you for your question.
Hello, sir. My name is Arman. Nice to meet you. Also, all these years, I read on Wikipedia what you did. Congratulations. I'm not nobody, but anyway, congratulations on what you did. We also invest in emerging markets. I had a question related to inflation, stagflation, and the investments that could be done. So, apart from commodities and apart from, let's say, mainstream public equities, do you see certain specific sectors or certain specific areas or even certain specific companies that you think are undervalued or that could have a potential of growth and a kind of comparative advantage in case there's a very high inflation? I don't know if my sentence is clear.
Yeah, I mean, I can see your point. There are, of course, a number of companies, sectors, where the leaders of these companies and these sectors have ignored the technology. In other words, for example, in the retail area, many companies have not fully grasped the impact of technology on their business. Home delivery, shopping online, that sort of thing. And those are the places where they're going to be in trouble. But it's not only in the retail area. There are many other sectors where technology has not been fully utilized, and they will be overtaken as a result of having ignored the impact of technology on their businesses. And by the way, that could mean anything. It could be mining, it could be medicine, it could be any sector, because the impact of technology, the advances that are being made in technology are having an incredible impact globally, and you can't ignore it.